Welcome to Simple Investing Secrets. In today's video, we're going to review 10 no-brainer dividend stocks to buy in 2023. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. As the economy changes, investors have every reason to look into easy-to-understand dividend stocks to buy for 2023 and beyond. This is not a marketing trick. Instead, people need to steer clear of analysis paralysis and focus on intuitive dynamics while managing their portfolios. A no-brainer stock has great future growth potential and is a buy today for some very obvious reasons. These companies are also often market leaders. The market is currently flooded with no-brainer purchases. The economic downturn has left many otherwise strong companies trading at bargain prices. Many investors neglected dividends during the previous lengthy bull market. Today's environment is different. Now more investors are aware of the potential importance of dividends. Total returns are enhanced by dividends. While you wait for the stock market to recover, they also pay you. There are several excellent dividend stocks available. But some really stick out. Here are 10 no-brainer dividend stocks that are obvious purchases for 2023. Number 10. Microsoft, ticker, MSFT. The company owns the language of business, which sums up the larger optimistic case for Microsoft. Microsoft Windows has about 76% of the desktop operating system market around the world. Microsoft offers a forward yield of 1.21%, making it one of the best no-brainer dividend stocks to buy. It won't make you rich, that much is certain. Do keep in mind that the company's payout ratio is lower than 29%. This shows that even though these streams of passive income are small, investors can count on them to be steady and reliable. But don't forget that Microsoft dropped 33%. In our perspective, it's a fantastic deal given the industry titan the company is. Further, according to GuruFocus.com's own estimates, MSFT is a play that is mildly undervalued. The combination of balance sheet stability, double-digit revenue growth over the previous 3 years, and an exceptionally good business quality return on equity of about 43%. Number 9. Walmart, ticker, WMT. The big box store Walmart, which everyone seems to love to despise but yet patronizes, will become indispensable. The World Bank said that when other central banks limit the amount of money they give out, a global recession could happen. Walmart has a forward yield of 1.61%, per dividend.com. It's not really noteworthy, just like with Microsoft. The company's payout ratio on the other hand is 38.3%, which shows a steady flow of passive income. Additionally significant is the fact that WMT is trading at a little discount, down about 4% year to date. Given the potential consumer pressure that we could be facing, WMT might be a good deal. It's without a doubt one of the best dividend stocks to buy without a second thought. Even though it's not the cheapest stock, the company's finances are pretty stable and its margins are good for the industry. Additionally, it is becoming more relevant, so capital appreciation from here is not ruled out. Number 8. Aflac, ticker, AFL. Aflac has always been important because it is one of the biggest providers of extra insurance coverage in the world. Aflac covers financial holes imposed by insurance coverage gaps. Now that the coronavirus pandemic has sharply reinforced the idea that stuff can happen at any time. Moreover, it can be utterly devastating, thus cynically bolstering interest in Aflac. Per dividend.com, Aflac provides a forward yield of 2.37%. We're not talking about millionaire-making material here, though it's an improvement over the other dividend stocks to buy. At the moment, Aflac has a payout ratio of just under 30%, which shows a steady flow of passive income. Also, keep in mind that the company has a track record of 39 years of consecutive dividend increases. Another factor to consider for AFL is its market performance. The security index has gained nearly 16% since the beginning of the year. In contrast, the benchmark S&P 500 shed a very worrying 22% of market value. Part of Aflac's outperformance stems from the direct correlation between rising rates and rising valuations of insurance stocks. Number 7. Coca-Cola, ticker, KO. Coca-Cola is one of the best-known companies in the world. It could be used to describe the United States and the way it does business. Travel pretty much anywhere in the world, and you'll find Coca-Cola advertising all over the place. Coca-Cola has a forward yield of 2.99% as of January 2023. We're moving into the better category of dividend stocks that are a no-brainer to purchase in terms of payout. However, there is a higher risk involved. The payout percentage is just below 70%. Although it isn't flawless, we wouldn't characterize it as unstable either, rather, it is something to be aware of. Positively, Coca-Cola has consistently raised its dividend for 60 years. So certainly management will probably go to whatever lengths it takes to maintain this prestigious reputation. To be sure, KO isn't cheap, trading at 23 times the estimated earnings. It has nevertheless had double-digit book growth over the previous 3 years. Additionally, it has very high margins, which increases trust in that yield. This makes it one of the easiest dividend stocks to acquire. Number 6. Chevron, ticker, CVX. Chevron, despite being a somewhat contentious figure due to its core hydrocarbon industry, only represents a need at this point. By the end of 2021, it was clear that we were eager to start making plans for a clean, renewable future. Vladimir Putin, however, had different thoughts regarding the stability of the world. Additionally, CVX seems cynically alluring as Russia continues to threaten the West with hydrocarbon outflow restrictions. Chevron has a future yield of 3.19%, according to Dividend.com. Despite being one of the leading blue-chip dividend stocks with the highest yields, it trails the sector average of 4.24%. But here's the Chevron situation. First of all, it has a payout ratio of under 34%. It's a strong, reliable ratio when compared to other energy bets, which include high-yield dividend traps. We're also talking about 35 years of uninterrupted dividend growth. CVX isn't cheap, like some of the other dividend stocks to buy. It trades for 11 times projected earnings, which places it worse than more than 72% of the competition. However, it has great financial stability and a 13.7% return on assets, which are signs of a high-quality company. Number 5. Johnson & Johnson, ticker, J&J. Johnson & Johnson is a stock that should be either near or at the very top of your list if you are looking for a dividend opportunity in the healthcare sector. Even though inflation, economic problems, and even legal problems have all been obstacles, the company has had little trouble making big profits and even raising its dividends over the years. Because J&J plans to split off its consumer health division this year, the company will soon be doing things in a very different way. The dividend yield on shares of J&J is significantly higher than the average dividend yield on the S&P 500, which is 1.8%. If previous patterns are any indication, there is a good chance that the dividend paid by the corporation will increase consistently in the years to come. J&J has maintained its tradition of annual dividend increases for the past 60 years. The dividend payments made by the corporation have climbed by 85% over the course of the past 10 years, representing an average compound annual growth rate of 6.4% throughout that time period. The previous 12 months saw Johnson & Johnson earn $17.7 billion in free cash flow, which is 54% higher than the $11.5 billion in cash dividends that the company paid out during that time period. Due to the fact that the company is only paying out 61% of its earnings in the form of dividends, there is significant potential for the payout to increase. Because J&J plans to split off its consumer health division this year, the company will soon be doing things in a very different way. This could turn out to be the pharmaceutical and medical device markets, which are both larger and have greater potential for expansion. There are plenty of other companies that provide dividend yields that are higher than what Johnson & Johnson does. But J&J is a dividend stock you can buy that won't put your portfolio at risk in 2023, which is expected to be a very volatile year for the stock market. Johnson & Johnson is a stock that should be either near or at the very top of your list if you are looking for a dividend opportunity in the healthcare sector. Even though inflation, economic problems, and even legal problems have all been obstacles, the company has had little trouble making big profits and even raising its dividends over the years. Number 4. Eli Lilly, ticker, LLY. People who are interested in dividends, like most investors, look for corporations that have strong businesses since those corporations are more likely to increase their payouts and are less likely to reduce or postpone them during economic downturns. To put it another way, this is precisely what makes Eli Lilly shares such a fantastic dividend investment. Think about the fact that the pharmaceutical company's profits have more than doubled in the last 5 years, even though there has been a pandemic, a rise in geopolitical tensions, and economic problems that haven't been this bad in decades. Since Lilly's product line, led by the diabetes drug Trulicity, will continue to bring in stable and regular revenue and earnings, the company has no plans to stop increasing its dividends anytime soon. Also, there are newer treatments that will help boost its results to even higher levels. The company was able to get approval for Mounjaro, a treatment for diabetes that, if it works as well as it could become one of the most commonly prescribed drugs in the world. Eli Lilly expects to receive up to 4 new product approvals by the end of 2023. With donanemab, a viable treatment for Alzheimer's disease, the pharmaceutical company could achieve what so many others have not been able to do. If it is given the green light, donanemab will almost certainly be added to the roster of Lilly drugs that bring in at least $1 billion a year. The pipeline for Eli Lilly contains a significant number of other interesting possibilities. Lilly has been a market leader and an innovator for a long time, especially in how it treats diabetes and obesity. Because of this, it has been able to maintain consistent financial success. Last year, Lilly provided its stockholders with a return that was significantly higher than the market average. The payout of its dividend was the icing on the cake. To be fair, the dividend yield of the company is only 1.24%, which is on the lower end. Despite this, Lilly has maintained a remarkable streak of dividend increases in recent years. It also has a good payout ratio, which means it should be able to keep raising its dividend. Number 3. Intel Corporation, ticker, INTC. Intel designs, manufactures and sells computer products and services globally. The company operates through several different segments, including Mobileye as well as segments that make computer hardware, chipsets, memory and storage products, and more. Intel was started in 1968, makes about $63 billion in sales each year, and is worth $111 billion on the stock market right now. Like many technology stocks, Intel's share price has declined by 50% in 2022, excluding dividends. Intel has increased its dividends for the last 8 years in a row, which is pretty good for the technology industry, where dividends aren't usually a big deal. Intel's payout ratio is 75% for this year, so we see limited upside in the dividend apart from the company's earnings growth rate. The yield is excellent, however, at 5.4%, making Intel a high-yield stock but also extremely high-yielding among its technology competitors. It is a rare income stock in a sea of stocks focused mostly on growth. Speaking of growth, we think Intel will be able to deliver 5% earnings per share growth in the upcoming years, which will also help the business maintain its history of dividend increases. If earnings increase, more money will be available to return to shareholders. Intel actually trades ahead of our estimate of fair value at 12 times earnings, coming in today at just under 14 times earnings. That implies a 3% headwind to total returns from the valuation, partially offsetting the ample dividend yield. But when growth is added in, we see 7% plus total annual returns for buyers of Intel today. Number 2. AbbVie, ticker, ABBV. One of the pharmaceutical companies that we've discussed several times in recent years, AbbVie brings plenty of relevance to the table. However, we're mostly interested in its Botox unit under its acquisition of Allergan. The benefit of this is that as society becomes more normal, people will naturally care more about how they look. Cynically, that's a net positive for ABBV stock. Another checkmark favoring AbbVie's inclusion as a no-brainer dividend stock to buy. The company currently provides a forward yield of just over 4%. Its payout ratio is currently 50.5%. From a stability standpoint, it's not astoundingly great, but it's certainly not something that will keep you up at night. Also, don't forget that AbbVie features 50 years of consecutive dividend increases. As with the other aristocrats in the space, management will not let that go without a fight. Interestingly, GuruFocus.com rates ABBV as modestly overvalued. However, it trades at 12.6 times forward earnings, which is undervalued for the industry. Investors will probably pay the most attention to its growth and profitability, which are good in every way. Number 1. IBM, ticker, IBM. Legacy tech firm IBM generates some controversy, not because of anything it did. Rather, it's a painfully boring investment. For years, IBM lagged behind its tech peers as it dove headfirst into cloud computing initiatives. Unfortunately, Big Blue was late to the party. That said, it's been making up for the lost time. It is also the leader in areas like artificial intelligence and machine learning, which are very interesting. Per Dividend.com, IBM features a forward yield of 4.8%. This ranks very favorably compared to the tech sector's average yield of only 1.37%. Investors looking for dividend stocks to buy should also note that IBM has actually gained 1% so far this year. To be fair, Big Blue also carries a high payout ratio of nearly 69%, which isn't the most favorable statistic. Still, the bottom line is that the company has had 28 years of consecutive dividend increases. Finally, the price of IBM stock is more than fair. Particularly, the stock trades at 14.3 times forward earnings, below the industry median of 22.5 times. This concludes our list of the 10 no-brainer dividend stocks to buy in 2023. As always, It is essential to do your due diligence before committing your hard-earned cash to buying stocks or investing in the market. Which of these stocks would you consider adding to your investment portfolio? Let us know in the comments below. Remember to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thanks for watching, and best of luck with your investments.